Hello, my YouTube fans. Good day, good morning, good afternoon, good evening, wherever you are in the world. Welcome again to the Stephen Williams Talk Show. I want to continue from where I left off the last time about investing in the stock market. I did not get much of a feedback, but I believe that I need to do a follow-up because a lot of us don't understand the stock market and how it works. So I want to enlighten us how the stock market works. I touched on it in my previous video, but today I want to also talk about the aspect of it I want to talk about is about the risk and the reward of not just investing in the stock market, but investing in the real estate, investing in a business, any kind of investing. All right. Let us remember that when you decide to invest, you are taking a risk. But the higher the risk is usually the higher the reward. If there is no risk, there is no reward. If there is little risk, there is little reward. If there's a lot of risk, then chances are there's a lot of reward. You know, we can decide to live our life just ordinary. We can decide just to get a job, sit in that job for all our life, and play it safe. Okay, you can have a house, for instance, and you have equity, $200,000, $300,000 in that house, and you say, I will not risk losing my house by investing or taking out the equity. And you just live an ordinary life, and you continue that way while that money sit down in the house, and you could have put it to work if you know what you're doing, right? So you can live an ordinary life, no problem. If that's what you love, live an ordinary life. But let me tell you something. The people that makes real money and get rich or get wealthy, they are the people who take risk and they are rewarded for their risk. Yes, I know, I heard you, but they can lose too. Of course people lose. How are you gonna know? You've got to take calculated risk. Why people lose when they take risk is because some have just taken uncalculated risk. In other words, they did not take the time to pencil out how is this gonna work out. So all they do is decide that, for instance, I'm gonna just go down the road and buy a house with the equity in my house and I'm gonna live forever, happily ever after. It doesn't work like that. You've gotta sit down and find out, this house that you're buying, does it need fix up? How much fix up does it need? How much do I have to spend? After I spend that money, can I back some money on my money? You've got to sit down and think about how to calculate risk and rewards, right? So no one is saying go out and just risk losing your money, invest in the stock market, and just risk losing your money. No. Take for instance, a guy, Warren Buffett is my go-to person. This guy is one of the richest guys in the world. How did he achieve it? And where did he achieve it? Most times, he invested in the stock market. So even though the stock market is a risky venture, it's because a lot of us who invest, we don't stop to examine the companies. We just decide to invest money and throw it in at anything and any company anywhere. That's not how it works. You've got to calculate the risk by checking out the company, okay, that you're investing into. You look at the business model, look at the sector, whether it's technology or in the gas industry, whatever. You've got to look at this company Study how are they performing, how healthy are they in terms of their balance sheet, etc., etc. So no one is telling anybody just take up your money and go out there and throw it at any. That's not how Warren Buffett did. What he did was to study. He spent time studying the companies that he's going to put his money in. And when he sees that this company stock is selling for $50 when it should be $70 or $80 or $100, then he says, well, they're undervalued, and he buys that stock. And before you know it, those stock goes up in price. And that's how he gets rich over the years. He's never concerned about what happened in the stock market, because as I said in my previous video, the stock market is a roller coaster. It's up, it's down, it's up, it's down. So if you get panic when it's down and you sell, who's to be blamed? You. So don't put money in the stock market that you need tomorrow morning. That's stupid. Put money that is like an extra, so you're not in immediate need of it. Okay? Tomorrow morning you don't need that money. Next week you don't need that money. Put money that you don't need right away, that you can put away for 5 or 10 years. That's how you build wealth. You don't just put in tomorrow and, oh, it's down, I'm gonna have to sell. No, you lose your shirt. So you've got to calculate the risk. Calculate the risk. That's the emphasis today. If you're going in the stock market, do not put money that you need right away. Have your emergency fund stacked aside, okay? So that if you have an emergency, you're not depending on that money in the stock market. You have something to fall back on, all right? So, as I conclude this brief summary of investing in the stock market, and I will do some more follow-up, I'm just saying you can live an ordinary life by being ordinary. Take no risk and live an ordinary life. Take some risk and guess what? You can be rewarded. You can be rewarded. Even when you buy a house, take out a mortgage, it's a risk. But most of us are able to do our job and pay our mortgage for 30, 40 years. So why can't you buy, if you can buy one house, why can't you buy 2? How about 3? How about 4? And some people say debt is bad. Debt is bad, debt is good. It all depends on whether you sit down and you calculate this debt that I'm going to get into. Will it reward me or will it destroy my financial life? Okay? That's something you got to think about. And again, so you have to sit down and count the cost. You've got to sit down and do the calculation. If I take out the equity of this house and I buy something down the road and I decide to rent it out, how much can I get? What if the person stopped paying the rent? What happened? You got to think about all of that, okay? But what about if the person is paying and I got a good renter because I interview them properly, I check them out, and I make sure I'm getting somebody with a stable job, and I rent them out, and they spend all their life, let's say, in my house. And 10 years time, that house that I had bought out of using my equity, I bought it, say, for 200,000. Now it's worth 500,000. I made 300,000 while I was getting rent. Hello? So it can work. Risk. You gotta take risk if you want the reward. If you're a coward, then you will never know what life you could have lived. So most people have resigned to themselves just to, I just live an ordinary life. I just go to my job. I just work for somebody. I'll go through the hamster's wheel every day. I just go to work and go in a cycle. And when I get paid, go to the bills, and I'm okay with that. If that's your lifestyle, that's fine. It's fine too. Whatever makes you happy, man. Whatever makes you happy. But I'm just saying on this channel, there are possibilities everywhere. Yeah? If you want to follow Dave Ramsey too and say, don't take any credit, don't get into debt and buy cash, it's a safe way, right? And maybe the best way, because that way, when you buy cash, you owe nobody anything. But it takes long. How long does it take for you to save $200,000 to buy a house? It takes almost forever. So the short route is borrowing the money, but borrowing safely and putting that money into an investment. I hope you got it, man. I will continue this series and we will build upon it more and more each day. Thank you very much again for listening. Don't forget to share this video with somebody. Like the video. Don't be afraid to leave me a comment below. And look forward to my next video as I continue this series of investing, taking risk, benefiting from risk and reward. Living ordinary or living extraordinary. Thank you.